one of the big questions I always get with some of my buyers is credit and credit checks. And if I go apply for a loan, it's going to hurt my credit. I know it's a little bit different with mortgage versus like going out to RC and get some furniture or getting a car loan. But with the credit checks, with the mortgage, how does that work?
Yeah, so you kind of hit it on the head there, and there's a lot of misunderstanding out there, and I just hope I can clear things up a little bit for folks, is that a mortgage inquiry or credit inquiry from a mortgage lender is different. It's a different algorithm, different scoring model that's run versus, say, like the credit score you get on your credit card or at a consumer level, right, for a credit card or an auto loan or something like that, right? If you're in at a a department store and they offer you a credit card, they're going to check your score, and it's on a different scoring model that's used for that. So those can be a little bit misleading. People will call me often and say, "Hey, I know my credit score," and oh, great. Well, what's the source? I ask them, and they say, "Well, my credit card gives it to me." Okay, and then I have to kind of explain the differences between the consumer credit model and a mortgage model because they are very different. And typically the mortgage model is a little bit lower in score than, say, the consumer model because of just the range of scores that are available there. So it's just a completely different scoring model. So it's a little bit different for a mortgage, but a lot of folks are a little bit concerned at first, like, I don't want my credit run. I've got great credit. I don't want you to run it. But that's the thing we need, right? So I guess kind of another way to an example, if you will, in a different industries, like in medicine, right? Like if you have an issue with your knee and you go into your orthopedist and say, "Hey, I need knee surgery," and don't allow them to do an X-ray or an MRI or any kind of scan or lab work or anything, right, to diagnose how to treat your knee, right, or whatever's ailing you. That'd be kind of the same in our world of like, I don't want you to pull my credit, but I want you to tell me what you can do for me, right? And so really for us, that's kind of like our best way to diagnose your scenario and how we can best help you. And oftentimes too, where clients will have something erroneously reporting on their credit that's negative, right, negatively impacting their score. And if we pull that credit early on in the process, we can help them game plan to overcome anything that's on that report or help correct anything or improve their score as much as possible between at the point they first call us and apply and when they actually buy a home. So a lot of misunderstanding about credit and a lot of hesitation with credit, but why work towards having a really good credit score and then not using that credit score when you need it to be a benefit the most, right? And it really just helps me guide somebody on the path. Like I don't sell anything, right? I'm educating and I'm guiding, and just like you on the real estate side, we're educating them and empowering them to make the decision that's best for them and their family. And so there's a lot of hesitation in our industry about getting your credit pulled. But what we do at Neo that's a little bit different than most lenders, I would say, is that we do a soft credit pull up front. It doesn't give me everything, right? But it gives me a really good idea. I get 2 of the 3 scores. And in mortgage, we use the middle score of the 3. So we'll pull from the 3 major bureaus, and whatever the middle score is, that's one we'll use. So worst case scenario, we know what your lowest possible middle score is, because we don't know what that third one is, whether it's the highest or actually the middle or the lowest, but it gives us a good idea of where you're at credit score-wise, and then also helps us know what's reporting, if anything erroneously is reporting or anything negative that you're not aware of, right, is reporting, and then it helps us give you guidance right out of the gate, accurate information as opposed to working hypothetically and potentially misleading you. Now, the beauty of the soft credit pull is that it doesn't negatively impact you on your credit profile like a lot of folks are afraid of. Like, I'm going to get my credit pulled. It's going to ding me 10 points. I work really, really hard to get, 780 credit, and it's going to damage my credit. So at first, right out of the gate, we'll do the soft credit check, put together some options for you and help educate you. And then when you're ready to take that step and get a formal pre-approval done, then at that time we would pull the full credit report.
I was going to ask you about that too, is because I've got some clients that, they say, I'm not quite ready yet, give me a little bit. But I always suggest to them, at least get your numbers looked at. Let's see what it's at, just in case. So we know going forward what you exactly need to do. And the question they always is, well, I don't want it to hurt my credit. I don't want to ding my credit. I'm not ready yet. And from what you're saying, it doesn't really hurt that credit.
No, I mean, and even if you did the full report pull, right, the full credit profile, it's going to be a very minimal impact to your overall score, right? I mean, your scoring model, depending on the bureau, is a little bit different, but it's well over 800, right? Well, I mean, if you had, let's just say, for instance, $850 in cash, right, and I needed to borrow 10, you're probably okay with that, right? It's not an astronomical number as opposed to how much total dollars you have. So yeah, that first poll may, affect you negatively a few points. Everybody's algorithm is different because everyone's credit profile is a little bit different, right? So the way it's going to impact one person versus the other is a little bit different. But yeah, there will probably be a few points there, but credit inquiries don't stay on there forever, right? They're going to eventually drop off, and then that goes out of the algorithm and you gain those points back. So, but to really know what we can do for you from a mortgage standpoint, what your options really are, and help you best game plan and remove any doubt, of your ability to get a mortgage, that's like key. That's like the first step we need, is that application and credit report.
So, and how much does this cost someone to come in and have them check you out? And
very expensive. It's free 99. So there's like no cost, right? Initial consultations, just to meet with me for 30 minutes to an hour, go over your hopes and your dreams, is what we call it, your hopes and dreams call. So I can get a big picture understanding of what, what you're looking for. And not only just as far as like buying the home, but like all the way across the board financially, right? Like we'll dive into, assets and liabilities as well. Like I want to take a big picture look at your profile and how I can help educate you and give you some recommendations, some different options, and really maybe even at times, and this may come out a little wrong, challenge your thought, right? Is that a lot of clients come in and know exactly what they want, or they think they know exactly what they want. But I like to give them a couple of different options they haven't even thought of, that they may go, wow, like that makes more sense to, say, put a little bit less down into my home, and then because of the high, consumer debt I have, put more money on that. That drives down the, household budget, if you will, like the household debt ratio, right? So eliminate some of the other debt, put a little bit less into my home, right? I'm going to finance a little bit more, so my mortgage payment is a little bit higher, but we get more bang for our buck, so to speak, by putting a little bit less down and removing that consumer debt, because those payments on the consumer debt are going to be higher, and especially most of them are higher interest rate, whereas the average credit card right now is over 20%. Auto loans are in the teens, right? So if you've got this given time, somewhere ballpark around a 7% mortgage rate, it would probably make more sense to eliminate that consumer debt, shrink that monthly outgoing expense there, and then by putting a little bit less down, it doesn't move the needle a ton on the mortgage payment. People are really surprised when they see, oh wow, I could really shrink my budget overall by eliminating some other debts. So that's something that we'll take a look at, and like I say, just challenge their thought process a little bit and give them something else to think about.
so, like you said, that is free 99,
Yeah.
FREE, free 99. Get in there, have your numbers looked at, have Matt get you on a game plan at the very least. I mean, if you think you're not quite ready, you've got other bills you got to take care of or whatever, at the very least, he'll put you on a game plan and get you on a path to go where you need to go. At the very least, you're building your credit, you're fixing your credit.
That's right.
And it's free.
Yeah, cleaning it up and then just creating that game plan. And then I'm there every step of the way along with you, shoulder to shoulder, right? And just helping clients execute on that game plan that we create initially.